morning, Matt. How are you?
Fantastic. How about you?
Doing well. As you guys know, I am Brittany Fry. I'm a realtor in Clarksville, Tennessee, also licensed in South Carolina. And the bulk of my business is all veterans. We are a military family ourselves. My husband is active duty in the Army, and over 75% of my clients are military. So I wanted to bring you guys the best of the best, which is Matt Wilson. He is a lender. He's been in the mortgage business for about 6 years. He's also prior military as well. So he's coming straight from the horse's mouth. He knows exactly where you guys have been, where you're going, and how to get you there. Matt also is a dad of three awesome boys and is married with a beautiful wife, rides motorcycles for fun, and also likes to play the bass guitar. So that's a little bit about Matt. You guys know a little bit more about me already, but I wanted to bring Matt on here to help have a really clear understanding of the VA loan process. There are so many misconceptions, so many questions along the way, things that I've run into. So we're going to problem solve and be proactive and make a great plan for all of our veterans to move forward for a smooth process. Does that sound okay for you?
Fantastic.
All right, awesome. So let's get the elephant out of the room. Has the housing market crashed? And what are rates looking like?
It has not crashed. It hasn't imploded. It hasn't exploded, whatever horrible term somebody wants to use for it. It's still there. Um, rates, they're rates. They're definitely not the same rates you used to be able to get. If anything, I would use right now as a time to pause and say, for the last 6, 7 years, as long as I've been in mortgage, it's always been the wrong time to buy a house, according to whoever you asked. 2017, 2018, it was the wrong time to buy a house because rates on their way up to the high level of peaking around 4.75. There's people out there that would kill for that right now. And then obviously into 2019, we transitioned into COVID times, early 2020. Well, then it's not the right time to buy a house because of COVID. Well, then the housing market launches like a bottle rocket, and it's not the right time to buy because housing prices are expensive. Well, then the interest rates go up, and now it's not the right time to buy because interest rates have gone up. But the problem with that logic is, from the time I bought my first house in 2015 to today, that particular home increased in value from $115,000 to 275. So inflation is real, and the only thing that I see that's a reliable hedge against inflation is going to be owning a home, because rent is going to go up guaranteed just about every year. Likewise, even with people investing in the stock market, I was talking yesterday to my financial planner. I was like, man, what's going on in your world? And he's like, it's kind of a misnomer. When you look at the S&P 500 index, everybody's like, wow, everything's going up. But that's only carried by like 7 companies. It's not all of it that's going up. It's really, your Teslas, your Facebooks, your Googles, and those type that are actually the ones that, excuse me, Meta, that are the ones that are actually going up. The rest of it's pretty stagnant. So, as eggs get more expensive, gas gets more expensive, rent gets more expensive, the one thing that you can do is go ahead and own something so that that particular piece of your life doesn't get more expensive.
Right. Yeah, that's an awesome point. When you get locked into a rate, that's not going anywhere. Like it is what it is. If anything, you can refinance in the future and it'll go down, but you have a steady payment. It's not like when you're in a lease and next year they're going to increase the rate again. 10%, $100, $50, whatever it is, it all adds up tremendously. And I've seen here a lot of people that have tried to move family members just because they have had their rent hiked up so high that like an elderly parent can't live where they were at anymore or stuff like that. And that's such a shame. And if they were set up correctly from the beginning, then they would have never been in that position to end with. And I don't want that for people. But with that said, we always have to be prepared and ready and know what the steps are to get us to be able to buy a house, right? Knowledge is power. And the only way that we're going to know is to ask those questions and actually get good information. One of the big misconceptions that I hear a lot is that VA people think, oh, it's no money down. I can buy a house without any money. And that's so not the case. So I want to make sure that we are setting a clear standard of what the expectation is along the way for cash you'll have to spend during the process or at the closing table to actually get them into a home. But before we go there, we need to know what makes you eligible for a VA loan? Like, what's the qualifications? What do they need to do? And is there a difference between active duty and guard or retired? Like, what does that look like?
Yeah, so in simple terms, leaving out the credit side of the equation for right now, to be eligible for a VA loan, you need to be in the military or a veteran in the military. Now, if you are on the guard front, you have to have 6 good years of service. Just the way that it's termed in the guidelines. I actually called the VA one time to ask them what 6 good years of service looked like and like what counts as a good year. And they essentially told me show up to a couple of drills, have a couple of beers, and that's a good year. And I'm like, seriously? And they're like, yeah, pretty much. I was
Yeah.
like, sounds like a good year to me.
Yeah.
So 6 years. Now you can wind that back with some with 6 months on orders, not necessarily training orders, but 6 months. Getting deployed or something like that. Then on the guard front, that opens that up. Now, obviously, if you're active duty, you're eligible pretty much as you get out of your basic training. I mean, it's not a whole lot. Well, an AIT or tech school or A school or whatever the Marines call it, you get the idea. That's you're pretty much eligible towards the front end of things. As far as one other piece to touch on is that VA does have a funding fee, as do all government loans. The exception with VA is if you've got somebody that's a veteran with a service-connected disability, then that funding fee is going to get waived. That's the situation where I find VA becomes the most cost-effective.
Yeah, that's awesome. And that's one of those things where we talk about the differences in a VA loan versus other loans that people don't necessarily understand. When we're looking at, when I'm looking at somebody that's going to be purchasing with a VA loan, I want to know how long they're planning on staying somewhere. And, you want to talk about the right time to buy, right? Back in COVID, when everything was a bidding war and people were paying cash differences, I don't think it was stressed enough that people understood that there's a funding fee that gets added on top of your mortgage. So if you paid a cash difference, you are upside down in that property. And in 3 years, it's probably not going to appreciate enough to get you out the cash difference that you paid plus the funding fee and to have equity in the home via paying your mortgage. So I think that's really like people need to understand that if you're going to get a VA loan, right, that funding fee gets added in on top. And to my knowledge, right, we pay the funding fee off first and then it starts to pay towards the principal balance, correct?
Yeah, the funding fee just gets added to the principal balance. So, if you're the standard first time user of the VA loan, it's 2.4%. So if you buy $100,000 house, that loan amount, which haha, right, $100,000 house these days, but easy math, that loan amount is going to be 100 to 400. So in a manner of speaking, yes, that's exactly what happens. You're paying that first before you get into the actual principal balance.
Cool. And it's not a bad way to go, right? Because it does totally help us get into the door. And one of my big tips that I always give everybody is just to pay a little bit extra towards the mortgage each month, and then that goes away so fast, like the next $50 or $100, and we can be ahead of the game. So because that's one of the big things that I hear is, well, I'm only going to be here for 2 years or 3 years. Can I even get out of this house? And that's a big question that we have and look at, when we are buying and selling. But in terms of the funding fee, you said the first time we use it, it's 2.4, correct?
Yes.
Okay, so what does that mean? If we use the VA again, can we use our VA loan a second time? And if so, does it change? What does that look like?
Yes, it does change with each usage. It also changes with down payment. One of the misconceptions of VA is that you can't do a down payment. I've had people ask me that before. Just because you can do 100% doesn't mean you have to. So there's plenty of situations where I'll do a VA loan for a family because financially it just makes the most sense, and they still put money down. That being said, there's so many different variables there. What we can do is I'll add a link to this video later. That way you can click and see the different usage table per the VA. Because the other thing is by the time we post this, what if the VA changes it?
That's true. That's very true. So I think the bigger thing is always being connected with somebody that knows the up and up right now, right? So that's not my job to know, what the rates are, what all the programs and systems are available on the lending front. That's why I've got you. So I think that's really important to make sure that when you're working with a realtor, like they've got somebody that's on their side that knows the ins and outs. And it's super important to me to have somebody that has specific like VA experience, because not all lenders do a whole lot of VA loans. And with that said, there's some other costs that come along with purchasing a house. It's not just the down payment or the funding fee. What other fees do buyers typically have to pay when it comes to a VA loan?
So on the closing costs, they're going to be separated into a couple of different sections. Typically, if I'm talking to a first time buyer, they've bought a car at some point in their life. So I'll compare it to that. You'll have somebody, you go to the car lot, you agree that you're paying $25,000 for the car, and then by the time you leave, it's somehow $30,000 for the car because you had to pay tax, title, license, whatever state fees there are. You probably got a warranty on the car, gap insurance, the whole 9 yards. Housing is going to work the same way, proportionally speaking. It's a smaller percentage than a car, but when you're talking about something that probably costs $300,000, the dollar amount itself can be high. So the first section is going to be your lender fees. The lender fees are obviously the stuff that gets paid to the lender. That's going to be typically, I call them junk fees: origination, processing, underwriting, all that stuff. They different ways of saying the same thing, and just an admin fee basically. And then after that, any discount points that are paid. Discount points are, in simple terms, just paying a little extra so that you've got a lower interest rate and lower payments over time. Beyond that, there's also some lender fees that get passed through the lender, so to speak. So for example, we have to pull a credit report. That fee gets passed along to you. We're not making money off that credit report. It's just that fee passed through. Then you've got your title fees. The title company is going to be the company that makes the home legally yours once it's all said and done. That's the attorneys involved for the most part. And then you've got your Uncle Sam related fees where you've got your taxes and property like register of deeds type fees going on. Beyond that, you also will have prepaids. Whenever you move into the house, you're going to have to pay a prorated version of what you owe on property taxes, and you're also going to have to pay for your insurance. Those are things that would be there whether you paid cash or had a mortgage involved.
Right.
As are most of the title fees. So, all together, this is just a loose rule of thumb. Closing costs are going to be somewhere in the 3% ballpark. Use that as a loose rule of thumb, but every scenario is going to be a little bit different.
Well, and that's all cash that's going to be owed at closing. So the day that we sign and get keys in hand, we're going to be making a wire transfer, bringing a check, whatever, for that amount. So this proposes the next question. As an active duty military family, I know this all too well. We made 4 moves in a year and a half, and cash is not plentiful. We don't always have a lot of money sitting in our savings account waiting for these moves, and especially these families that might have to move every 2 to 3 years. So the idea of having a lump sum of cash to bring to closing is a little intimidating. And I don't know, I think that stops a lot of buyers in their tracks when they find out, oh, I have to have $6,000 to $10,000 sitting aside, and they don't have it. So what are some ways that we can combat that? Like on my end, obviously, we can try to negotiate a credit from the sellers to go towards the buyer's closing costs a little bit. But I know there's some rules and guidelines there too. So will you kind of cover how much of coverage could we get from a seller? Is there a specific amount or percentage that we have to, aim for? And then outside of that, are there any programs or, talk about like the gift money? How does all of that work so that we can still be able to get to the closing table if we don't have, 10 grand sitting in our savings account for closing costs?
Yep. So there's 4 basic ways that can go. The first way would be obviously out of your own bank account. The second way would be gift funds, like you mentioned. Now, here's the thing with gift funds. Technically, gift funds can come from a close friend or relative. The problem that you run into with the close friend part of that equation is how do you document that it's a close friend?
Right.
And Facebook pictures are not quite enough to document as a close friend. So my advice is if you're getting a gift, make sure that it's from a relative that's legitimately a relative. The next way would be through seller paying the closing costs, and that's where it comes up on your end of things. A lot of times if I'm talking to a family and I see that cash is tight, I'll recommend to them, look, before you negotiate down the price of a house, which is still questionably difficult to do in this market, I believe, Negotiate having the seller pay some closing costs, because if you've got 250 and you want to offer 240, there's no difference to the seller if you offer 250 and then pay 10,000 in closing costs, but to you, that's $10,000 less you've got to come out of pocket for. And then finally, the other way that you can have it covered is you can actually stack up sometimes some down payment assistance on VA loans, as well as most other kinds of loans. But VA also has some opportunity there in the state of Tennessee.
So, and if we do the down payment assistance, what does that look like? Do we have two separate payments, or how do we pay back that down payment assistance? What does that entail?
Yeah, so for Tennessee residents, you've got what's called THDA. It's where the state housing department is giving uh, down payment assistance for people that fit within a certain income bracket. Now, one of the cool things there is that if you are a veteran, you don't have to be a first-time home buyer to utilize that program. They'll waive that requirement, and you get to use it regardless if need be. Likewise, if you're a veteran, they give about 0.5% off the interest rate discount for the veterans compared to their normal version of the loan. So it's pretty sweet. In that scenario, there's two different ways it can be set up. The first way is a $6,000 silent second mortgage, and the second way is a 6% non-silent second mortgage. That's not the technical term, but just to contrast here. And what a silent mortgage means is that you don't have a payment on it. It's just hiding out silently in the background until you pay off the house, refinance the house, sell the house or something. You have to keep in the back of your mind that yes, that money is still owed, but it's not a problem until you go to move the mortgage in some way. On the 6% version, you do have a second payment on the house. Both of them are paid to the same. It's not like you've got to remember to write two different checks each month or something like that. It's rolled into one master payment, but it's two different loans, and it's going to work out that it's at the same interest rate as the mortgage is with the same 30-year term. So
Awesome. Well, that sounds like a great way to get a little bit of extra help in your pocket if it's not going to impact the loan going up or do a second, payment. Like you said, it feels tedious, if you had to write two separate checks and go, okay, well, what help was that really? I'm just having to have another loan, So that's awesome. And the silent, part of it, like if you can pay it back when you close, that's amazing too, because then you're not increasing your payment at all, to do that. So thank you for explaining. So one of the things too that came up recently, this was kind of a big conversation on a lot of the spouses pages. So you see all these questions pop through that people are experiencing or having happen. And one of the things was families separating, right? Regardless of whether they're retiring or just separating from the military, and they're wanting to buy a house, wherever they're going back to. Somebody has, husband has a job letter, but he hasn't started yet. Or, he's in his terminal leave and can't get a job yet. And we want to go back home and he's still here. Can they buy a house? What does that look like? So if you're separating from the military, what do you need to do to be able to be ready to purchase a home and not be in limbo and with nowhere to go?
Yeah. So there's a couple of rules of thumb that in some senses get thrown out in VA loan situations. So typically you have to have, say, your first payment due before your first or after your first paycheck is received for a new job that's offered. VA is very non-specific on that subject. A lot of it has to do with the reasons that you're talking about, because it's not uncommon for a family that's in, Port Hueneme, California, to have to decide to move back somewhere this side of the country, and they're not going to have everything all buttoned up nicely. Now, you do need to have a job offer together. You can't just totally go without anything. If it's somebody's retiring, obviously you've got the benefit of that you're going to have retirement income, so that's obviously going to count. But on the job side of things, you want to make sure that you've got a job offer lined up, and that it's not going to be contingent on anything. You need to have cleared any of the licensure requirements or background checks or whatever it is. A lot of places will work with veterans specifically on that stuff, because obviously if you were in the military, you probably got the background checks covered tenfold compared to a civilian. But that's going to be your biggest caveat there that I would give, is make sure that there's no caveats to the letter itself, no ways that they would potentially withdraw the offer remaining. But there's not a specific timeline on VA, the same way that there would be on, say, a conventional loan or something like that. The best rule of thumb there would really be, go ahead as you're planning that, do the mortgage application. That way you can get things rolling. I can have you underwritten ahead of time, and then make sure that we've cleared even the underwriter discretion portion of the guidelines. So the other piece of that too is, when I'm helping families that are relocating or retiring or separating or whatever, sometimes they'll realize that the job that they were planning on taking when they got here isn't going to quite cut what they need it to be to qualify for the house they want. So they may decide to go back and negotiate on the offer some more, or start looking at some other options along the way too.
Okay. Awesome. And then when it comes to disability, this was kind of like part 2 of this little saga that was going on the spouses page, was, we're waiting on a disability rating. Can I use my estimated disability rating to be able to get approved? Because that's going to impact the amount of money they're getting each month, and whether they are or aren't working a full-time job, or whatever that looks like. So once again, we're waiting on the VA, which sometimes is not a quick process. What does that look like? What do you need in hand on the disability front if somebody was going that route?
Realistically, the estimate's not going to work. You don't necessarily have to have received the disability check yet, but it does need to confirm what the amount's going to be. So you've at least got to make it that far through the process. The other factor there is, like we mentioned a minute ago, the funding fee gets waived as part of a disability rating. Right. Now you can technically, from what I understand, go back. I've not personally had to do this for somebody, but you should be able to go back within a certain time frame and retroactively get the funding fee refunded. But in those situations, you're also not qualifying using the income from the disability as part of your qualifying income. If there's one rule that will kill a file, or one word that will kill a file in underwriting more than anything, is the word estimated. So that's the big thing.
Yeah. We're not in a guessing game, are we? Okay, that makes a lot of sense. So, if somebody's getting out, sounds like we need to do a better job of being really proactive, getting those appointments set, having our files ready to go. I think I heard the rule of thumb was 60 days from retirement, they can have the VA rating done. So we were at a conference the other weekend, and they literally said, like, when you're doing that terminal leave, like, you need to be going to all the VA appointments. They can do all of the appointments, do all of your assessments ahead of time. They just can't review the file until either 60 days of, or the day of that you actually retire. So I think that, like, we can help ourselves there if we're just a little bit more proactive and know, okay, I can go ahead and do this beforehand. Because I think so many times we think, I can't do anything until I'm done. The VA's not going to see me. They're not going to let me walk in the door. And from my understanding, they will. So we can have it set up so that we're not in such a pinch here, waiting for somebody to do something else on the back end. Because that's the worst feeling in the world, is not having control over the situation and needing to do something and needing to do it fast. And we're just waiting for somebody else. So that kind of proposes, this is just more of a general question, but the waiting game, it just kind of hit a spot for me. The 2 biggest things that we tend to wait on and during the loan process would be, the title work, which is not in your front, that's, in the attorney's court, but the appraisals. For a VA loan, what's the process for that, and what are the guidelines? I have so many times where people are like, why isn't the appraisal in? And there's some certain specific, like, date timeframes that appraisers have and that you have in terms of when you order it and how that process works, correct?
Yeah. So on the general sense, zooming out from VA, if we want an appraiser to do something quickly, they work just like the rest of us. You pay them more and they do it faster. Okay. When it comes to VA, you order through the VA, and only certain appraisers are allowed to do VA loan appraisals, and you don't have any ability to rush that. I have heard some stories of some agents that have great relationships with appraisers that make magic happen, probably with some Starbucks gift cards and things like that. I'm not suggesting that bribery is the solution, but
Hey, dates are a great thing sometimes.
yeah. Um, so, but the thing is that with VA, the appraisal is the one piece of the process that I would say the lender typically can have a little bit more control over, but it's ripped right away. We're not allowed to look them in the eye lest we turn to stone or something, when it's a VA appraisal situation. Now they do have certain, I want to say it's 14 days to have like scheduled and accepted and get it back to us. But if you've got a 3-week contract, 14 days puts you kind of up against the wire. And in my experience, much like I did my homework in high school and college, they're going to wait till day 13 to do anything.
Mm-hmm.
So it's very rare that you've got an appraiser that's just excited to go out and do something ahead of their due date.
So if we want something done fast, we got to be willing to pony up, is what I'm hearing. Kind of, that's how it's going to happen. Is if we have a rush fee put on it and kind of say like, hey, this needs to happen now. So once again, we need to be planning ahead of time. So in that front, what is the typical time frame from contract to close? So we found a house, we're under contract, and then we want to start the process to get to the closing table for a VA loan. What's your average kind of time frame to close a deal?
So 30 days is super comfy. Like it's super easy. That being said, with the way that the market was, there's in some ways the mortgage industry is probably still a little bit overstaffed. So like, whereas my personal processor used to handle 40 files a month, she's probably handling half. Means that if I say, hey, processor, if I'm your favorite person today, can you make this happen quickly? Like you can make things happen in a week or two. Legally, you can't. You can only close within after 7 days. But it's definitely not uncommon if the borrower is on their A game with sending in documentation and stuff. 2 weeks can happen just fine.
Okay, cool. So let's talk about documentation for a second. I kind of had 2 questions in my head. One, what kind of documentation do we need to have ready to go? And then 2, if we are not physically here, so let's say, I've had a client that's coming from Germany and they want to buy and have a house ready here. Can they do that? With some conventional loans, right? If you can't, not conventional, but like FHA loan, you can't buy unless you're already in the state, have a job in the state, all that kind of stuff. If they're not physically here yet working, can they buy from somewhere else? And how does that work, for closing, right? Can they close when they're in a different location? So documents that you would need. And the reason this is so important is because I have so many people that are packing up, right? We're packing up, we're getting ready to ship out, and we're not thinking about pulling out tax returns or W-2s or LES statements. So like what all do you need ahead of time so that we have a nice little checklist together of what documents to have prepared?
Yeah, so like the good news is these days a lot of stuff's digitized. That being said, not everybody's digitally organized. So with that, you don't necessarily have to have tax returns for every loan, but set them out just in case, especially if you're packing everything up and your one copy of them happens to be physical paper. Scan all that stuff in sometime. Or if you did it with tax service or something, you should have a PDF, but digitize it because you're going to have to send it in anyway. So, from that standpoint, you've got that. You got W-2s, LES, or pay stubs, depending on your situation. If it's somebody that's already retired, then their pension letters, their award letters for disability, all those sorts of things, Social Security, if it's that late in the game for them. Any of your income proving documentation, I'll just say that. Likewise, your pay stubs and LES, you'll need the last 30 days. Depending on your time horizons, like that's something you may just have to grab online. I'd say even more important than taking stuff out of the box is get one of those little cat card readers and that's USB oriented so you can get on MyPay super easy and take care of all that stuff super fast and simple that way. And if you're already retired and don't know what any of that means, then that part wasn't for you. But anyway, that's going to be your baseline stuff. Other than that, need the bank statements for whatever account you plan on using. We don't necessarily have to document, in particular for VA, we don't have to document the account that you got that's joint with your mom since kindergarten with $5.60 in it. We don't really care about that. But like your account with the money that you're going to use to close and prove income, that's the account you need to make sure it's set out. Copies of your driver's license, typically front and back copy there. That's going to be your generic, like, boilerplate document list for most people. Now, if you've got job offers on the horizon, obviously we need a copy of that job offer letter so we know what's up there. And then, if you've got divorces or child support situations, then we'll need the documentation for that sort of thing set out too. That would be those documents I could see being the ones most likely to not be digital for somebody, right there. But yeah, that covers the basic stuff. There's always a possibility as we get into the loan process, there's other things that pop up, but most of those other things are going to be as a result of something you've already sent. We've got to chase the little rabbit all the way to the end of the trail from an underwriting standpoint.
Do you need a copy of orders if somebody is moving like to a different location?
Yeah, if you do have if you are like getting PCS somewhere else, then the orders obviously help document why it is you're buying a house in Wyoming and currently live in Tennessee or vice versa.
Okay.
So yeah, that would be helpful. The other piece is if you're one that's in the retired camp or if you're in the guard camp where you get multiple of these, having your DD 214 set out be a good idea. Typically, we can get your COE certificate of eligibility on our end just fine. There's about 10% of the time we can't because, well, we've all dealt with finance before and we've all dealt with the VA before, so you know how that goes.
Yeah.
So in those situations, you may have to do a little bit of legwork on your end of things. Active duty, sometimes, so typically for a civilian employer, we have to get a verification of employment. On active duty, we might have to get a letter from your commander, essentially.
Okay.
It's basically for the same purposes. It's just verifying the employment, making sure that you're not eating crayons out, somewhere or something like that.
That's why you should be in the Army or the Air Force, not the Marine Corps, but that's a different story for a different
That's
day.
right. If you are in the Marines, comment below what your favorite color is.
When we were at Shaw, we had a civilian that was a Marine, and God, we had so much fun with that. It was a lot of fun. So you mentioned something that was a little bit triggering depending on who you're talking to. Like you started talking about separations and child support and some really sticky, crappy stuff there. One of the things that we need people to realize when they're working with a lender, and this is why I kind of tell people all the time, I need you to be more comfortable with your lender than you are with me, right? I don't go digging through my client's finances and past history in life. And you do kind of, whether you want to or not. And it's simply a check the box type of system, correct? You're sending over a file to somebody else is kind of coming back to you and saying, hey, Matt, I need an explanation of X, Y, and Z. And one of the things I've had run up is, we had a child on a tax return this year and not that year. And a lot of times, parents that are separated will split that. They get to claim a child this year and then you get to claim it next year. You would need explanations of that kind of stuff just because there's inconsistencies. And we need to know, that you don't really mind what's happening. You're not judging what's happening. That is literally, somebody else giving you marching orders and asking for this specific documentation to show why X, Y, and Z happened. Why is that so important to get that done quickly for you? I mean, this is, this is not you saying this has to be done. You have somebody else telling you that these items need to be done. So can you explain why? I mean, I know it can be really upsetting to people, why do you need to know this? Why do you care about this credit card that, got charged off 10 years ago? Why are those things important during the buying process?
Yeah. So zooming out first, and then I'll focus in there. A lot of what happened in 2008 was documentation oriented. At that point in time, leading into that era, there were a lot of loans that basically, if you could fog a mirror, you could get a house. I mean, it was pretty much that easy. What that resulted in is effectively watering down the mortgage market with a bunch of junky loans that likely weren't getting paid back anyway. And oh, by the way, let's throw them all in adjustable rates that are going to adjust at roughly the same time through the roof. And you basically set off a time bomb, essentially. So that's why now, from a general mortgage sense, as a result of the Dodd-Frank Act, we actually have to prove the ability to repay within certain guidelines. And those guidelines are going to vary smallly, in a minor way between different programs. But in essence, like, as silly as it sounds, if somebody applies for a mortgage and we don't prove the ability to repay, then that individual can actually sue us for giving them a loan they didn't have the ability to repay, which is ridiculous and flies in the face of basically everything that is honorable about a person.
Mhm.
If you sign up for it, then you chose to. The same way. Listen, we all signed up for the military, and there were plenty of times where when I did that, I was like, well, this was not the greatest decision I've ever made. And then there was other times where it was. But that right there is why the documents matter. Now, in particular with the triggering circumstances, divorces, deaths, child support situations, all that stuff. Personally, I don't care how many baby mamas are out there, baby daddies are out there. I don't care how many wives you've had, husbands you've had, whatever. Like, it doesn't matter to me. I'll probably judge you more for how much you spent at Taco Bell, to be honest with you, because I'll see that too on your bank statement.
Well, I put it on my credit cards and you're not going to see that, so it's okay.
There you go. Yeah, but ultimately, I don't care. But the fact of the matter is, if there is an alimony obligation, if there is a child support obligation, that counts just as real as a car payment does.
Okay.
On the flip side, if you're in the receiving end of that situation and you're receiving alimony, receiving child support, well, that is income that can be counted to help you qualify for a loan. So you're not required to disclose that you receive it in that situation, but I don't know why you wouldn't, personally. I mean, there's no real downside to it. Now, in those situations, quick side note, you do have to have actually received it for a period of time. That period of time varies from loan program to program, but we all know that person who knows the person who didn't pay the child support. That's why it has to be documented it's actually received. So ultimately, as the lender, look at it kind of like going to the doctor. I'm pretty sure that the doctor is not all that interested in seeing me with my pants down when I go.
Right.
But as part of a healthy checkout, check up, not check out. That was weird. You get the idea. As part of a healthy checkup, they got to make sure that they review everything. Same thing on this front. They got to make sure that the underwriters have to ensure that they have reviewed everything appropriate to the given situation. If you mark that you're divorced or that there's children, and in VA situations, you actually have to state how much you spend in child care expenses, because that's part of the equation for approving a VA loan in particular. So anyway, that's ultimately, I don't personally care. Even the underwriter doesn't even care. But what happens is, once the underwriters reviewed it, their job is also in question if they review something and don't properly document it. I won't name names, but currently there are some mega lawsuits out against certain companies that, through the refinance booms of the last couple of years, quit documenting files. Well, we just talked about what happened in 2008, so that's not a great thing.
Yeah, CYA, any day, all day, right?
Exactly. Yeah. It's the same reason why you should, and if you're not doing this is not mortgage related, keep your own personalized order folder saved digitally and physically in as many places as you can think of, just in case one day you get to go turn in your retirement package and they're like, hey, you're only here 19 years. And you're like, nuh-uh, I can prove it. I've seen that happen before.
That's a good tip. I don't think I've ever come across that before, but
yes, in particular on the guard front, I've seen it happen time and time again. People have to prove maybe they did 4 years active and 16 guard or something. They got to prove that they were there the whole time, or they're like, nope, you're retiring next year instead.
So annoying. It's like, let me hit the. So we have a loan A VA loan. We've been in our house 6 months. We've got orders. We're shipping out. What are our options? Can we sell? Do we have a limit that we've got to be in the house? Can I keep it and rent it out? What does that look like on the loan side?
Yeah, so obviously you can sell if you want to, and depending on the circumstances, that may be for the best. That being said, if you're in a military town, there's probably a relatively healthy renter market, and I've
Mhm.
come across plenty of veterans that were able to pick up a house in most of the different locations they PCS to over the years, and that was the beginning of their investment portfolio. I mean, you know, you can even, a lot of people don't realize this, you can use your VA benefits a couple of times and in some situations still go zero down in another house somewhere else. You don't have to, just because you've used it once, it doesn't mean that you can't use it again. If you sell the house, your entitlement's completely restored. If you don't, then you use what's left, the bonus entitlement, to cover your to cover insuring part of your or guaranteeing part of your down payment for the next house.
Okay, cool. And you said investment. It made me think about something. Um, can I only buy a single family house with a VA loan, or
You
can
know,
I
you
buy?
actually got
Yeah,
you
like so.
actually got me on that. I believe you can buy up to a duplex or a quadplex, but I don't want to say 100% on the quadplex front.
Yeah, I think quad four doors or less.
Yeah,
But yeah, so
uh,
I think one of the best like tricks that I've heard from so many people, I don't know that I'd be going out and buying a quad with a VA loan, but a duplex, my goodness, like if you, especially if you're a single military person, if you don't need a big old house and you want to use it as an investment, you get to rent out the other side, keep that money as additional income, and then have, I mean, that's probably going to pay your mortgage payment as it is. So you're basically living there free 99 just because you bought smart. And I think that's something that a lot of people don't realize. They don't realize I don't have to go buy a house. I can actually buy, a condo, or I can buy a duplex and be able to have a different type of investment. So if you're okay with, that type of scenario where you're all right being in a duplex, man, what a great opportunity, you know?
yeah. I mean, the duplexes sound better than the barracks or the dorms. Um, so I actually had a friend of mine, like this kind of leads me into the kind of the house hacking conversation. Um, One of his buddies, whenever he was stationed at Nellis out in the desert, one of his buddies bought a house and they all rented a bedroom from him. And because of that, everybody was getting BAH.
Yeah,
They didn't have to worry about getting that jerked away living on base. And I think the net benefit to everybody was pretty substantial. And then that guy was getting to get his equity grown over the time that he was hanging out there around Vegas.
that's awesome. Yeah. There's so many cool hacks there, and I think I love that people are learning and buying at a younger age, so that they can continue to have generational wealth. And real estate is such a great place to do that. We kind of made the decision that we were going to have a property per kid, like, and have that paid off by the time the kids were out of school. And that's going to be their property, their money, whether we sell it or keep it and have the cash come in monthly. So that's just an example. We bought our first house in 2015 in Sumter, and we still have that house. And we bought it with a VA loan. Same deal, kind of like you said. We bought it for 109,000. The last time we had it appraised, when we refinanced it a couple years ago, it appraised for 179. Never thought the house would be more than 120, 130,000. It's incredible. It's really great to see the appreciation in it. But we ended up refinancing that one out of a VA loan so that we could open up our VA loan again, use it 100%, and we've got that rental sitting there. So I mean, a VA loan bought our first investment property. So that's so cool, to see how it can work, and we can use it to our advantage. So there was something that I just thought about. Oh man, I lost it. I'll have to think about it. If it comes up again, I'll let you know. Do you have any other cool tips, tricks, things that we should know, especially if we are planning on getting a VA loan? What is going to make or break a deal? And I guess that's a common thing that we can have for all loans, especially the break a deal. Whenever we get
Yeah.
under contract, I guess that's an important question. When we're under contract, what are our big no-nos that we absolutely just cannot do to be able to, make sure we can get our mortgage?
Yeah. So like the first thing that I will say, and we've all, if you're watching this and you're on the veteran half of this, we've all been through those awesome 4 hour long death by PowerPoint personal finance classes in the good old military. But the first piece of advice would be they're stupid right off base on basically every base I've been to. Like, for the love of all things, don't go buy the dang 2011 Camaro at 29% interest as an E1 and be ridiculous. I've seen it happen plenty of times. It's just crazy. That's the first thing, because what I see that kills people's ability to buy more often than anything else is having a car payment that's like way beyond their means. I get that in this environment now, it's hard to even find yourself a gently used Honda Accord and not have a payment that's going to be $500 or $600 on the thing. But if you can tolerate it, the irony about my military experience was that I noticed most of the E5s and up drove a beater. Even the officers would have a beater.
Yeah.
And if there was like just the awesome Pimp My Ride mobile riding on the base, it was an E3 and below every time, maybe an E4. Shout out to the E4 Mafia.
Right? That's what you're supposed to use that for?
Oh, exactly. I mean, all your have tos are paid for, so why not? Like, why not go and have yourself a twin turbo piece of junk off of the buy here, pay here lot? So yeah, that's the first thing. The second thing is, really on the general mortgage sense, it's a little less military specific. The things that qualify you are job history, which if you're in the military, you got job history, because if you don't show up to work, you go to jail. Easy enough there. So that part's squared away. Also pretty easy to verify that you're getting paid because you're working for the United States government. So as long as they keep, re-upping the budget every year, you're going to get your paycheck. The next piece of it is the credit scores. Again, if you go buy a 20% Camaro, then that's going to hurt your credit score. Likewise, doing something like maxing out credit cards for Best Buy so that you can get the newest Xbox and a bigger TV to play it on in your dorm room or barracks, that's going to hurt you. On credit cards, never go over 20 to 25% of the limit. The next piece there is going to be your savings. You hit on earlier, there's a decent chance that even though you're doing 100% financing potentially with a VA loan, there's still out-of-pocket expenses. Even if the seller paid every penny of your closing costs, just going with that example, I still recommend people have about $2,000 saved up for several reasons. The first reason is if you can't save $2,000, probably don't buy a house. The second reason is you're going to have earnest money. Typically, that's going to be at least $1,000, depending on your market and what can get worked out for you. You're also going to have to pay that appraisal. It's going to be $600 to $700, depending on rush fees and things like that. You probably will have some level of home inspection you've got to pay for. So once you add all that stuff up, like there's your $2,000 right there. And yes, earnest money gets returned to you at the end, but you had to have it to start with to lock the house up, or you don't get to buy the house. Those are the biggest items that we're looking at whenever I'm running through an application. I'm like, okay, do we have our 2 years of job history? Cool thing on the military front is, even if you don't have 2 years, say you're 19, you've been in for a year out of high school, you enjoyed that last summer and then got screamed at by a guy in a funny hat. Well, you're good. Your high school counts as job history. Yes. That's actually an opportunity that I feel like the military gives people is that otherwise you wouldn't, is the fact that you do have a legitimate career straight out of high school if you want it, that you could buy a house with if you wanted to. I mean, think about how cool you'd be if you bought a house at 19 and you're 29 and own 3 or 4 houses at that point. You're also already 10 years in the military and halfway to that retirement if you so choose. Like, that right there to me is the ultimate way to get your passive income after putting up with the fun of the military. Yeah. So yeah, that's the biggest items though that we're checking out on our front to make sure that somebody qualifies.
So, and then once we're under contract, I kind of go into mama bear mode, and and I preach this all the time, and I think every lender does too. But once you're under contract, you're on a like no spending contract. Well, like we are not pulling the credit card out, we are not buying furniture, um, we're not taking lump sums of cash out of our checking account. Anything that moves around money wise ends up being a red flag to you guys, right? And you check it. I mean, like literally the week of closing, you guys are getting final bank
Mhm.
statements, correct?
That is correct. I've had, uh, you know, one of the things that I do at the beginning of somebody's pre-approval process is I will show you and talk through, these are all the items that said they have a balance owed on them on your credit report. Even down to the Amazon Prime card that's got like $5 on it where you bought a movie last weekend. Like we go through all that. When you're going through that, pay attention, because I have had people in the past that I did that with, and then we get a week out from closing and a student loan pops up that was there before but showed paid off, but it was transferring servicers. This literally happened.
Oh
And
gosh.
it almost caused them not to close because all of a sudden that's like a
I knew
new
that.
a new trade line, so to speak. But they didn't pay attention to what trade lines were there to start with. So definitely make sure that that lines up with what you know you've got going on. What's not counted there is utilities and things like that, but it needs to be your actual expenses. Don't go out because you got a new garage and get yourself a new car to put in it. Like, just don't. Ride your bicycle if you've got to till you buy the house. Like, don't get a new car because I've seen that screw things up. I've seen people go and finance a washer and dryer and nearly blow up their closing off of it. Like
Right.
Brittany said, we do have to pull a week or so out from closing. A quick look is what it's called. Well, if I look on there, I'm like, why is there a new credit pull from Best Buy? Well, that's going to open up the can of worms to figure out what it was exactly that you did at Best Buy. And if it means opening up a new credit card and that new credit card reports with a payment that pushes you over your debt to income limit or residual income limit,
We're
I
sitting
hope
up.
you enjoy it. Yeah.
Yeah. Yeah. I know. And some of that can be so hard to coordinate on the military front. Like I'm coming from overseas. I have a car maybe being shipped or I sold everything. And I'm getting here and I don't have daily squat. I don't have my belongings. I don't have my car. What the heck am I supposed to do? You need to be wise and think about it. Who do you have? Who do you know that has a military family that's, has a deployed member that has an extra vehicle that maybe they'll loan it for you for the week that you're here before you close on a house. Or think about all the places on base, they have like the places where you can like loan household items, get you a little couch and a table and a TV set up until your items get here. So make sure, like, we got to make sure we're tapping into all our resources and not screwing ourselves over, for lack of better sense. I don't know how to say that any nicer, because I mean, it's realistic. Yeah, we don't have a car and we need to get from point A to point B. What the heck do I do? But if there's a will, there's a way, right? And sometimes we get ahead of ourselves and we get so excited. And I tell people, I'm like, you can window shop all day long, but do not click that button. And the best thing that is, this is the beauty of Amazon, right? You can make those lists. So I've had clients that had like their house list and all the items they wanted sitting in it. And I'm like, this get us past the closing table, get these keys, and then get what you need. But you really don't need to buy a whole bunch of stuff for a house until you're in it anyways, because you're going to get in it and it's going to feel different, or you're going to realize, oh, I didn't need a couch that big, or, my bed isn't going to fit in that room, whatever the case may be. So I think just work for the wise. We don't have to get all hot and heavy. It's so exciting to go through this process, but we want to get you in the door. So when we are preaching to you that you cannot go out for an extra date night to the spa, speaking to the wives, right, for half a second, it's all a good reason. I mean, we all want to make sure that at the end of the day that you guys get keys in hand, and I think working together, it's really a beautiful process. I mean, we have an awesome opportunity here to have this VA loan and not have a down payment available to us, because that really is one of the hardest things about owning a home, is saving up the money to have a down payment. In my opinion, that's one of the things that I've seen consistently, is people work so long and so many years to save up for that down payment just to get in the door. So I think as a VA, person in general, we need to not take that for granted and be super, super appreciative of the fact that that's one of our benefits. You know, we don't get paid working for Uncle Sam like that very much, but the benefits being in a military household is definitely where it's at. So it's something we should be taking advantage of. There's just no reason, if you know, especially if you know you're going to be sitting somewhere 3-4+ years, buy a house. Do what you can to buy a house. You know, it is so worth it in the long run. Like you said, it's such a huge thing in 4 years to be able to say, okay, I can go buy another house now and I've got two, you know, like, wow, like that's really cool. And I think it's a good hack to generational wealth. We don't think about it. You know, somebody just said to me, I was talking to another agent this morning, and we're kind of close to retirement for the military. So we're going to be kind of moving into that phase, which is part of why I've been like seeing these questions and going, oh, I got to pay attention to this and know about this. But he said, you know, I know you're not going to be one of those people that gets out of the military and doesn't have a plan or doesn't have money set aside. And I said, well, you know, I don't know. We got a whole lot of money set aside in the world. I said, we just have money into real estate. And he's reminded me, real estate is cash money. It can be liquidated any day, all day. So it is a great way to put away money and have a savings account for later. You know, I think that if we can encourage everybody to realize how safe and solid of an investment real estate is, and we are not in 2008 anymore. Like you said, they have, you know, we have buckled down. We make sure people are qualified, and we don't have all these adjustable rate mortgages. I think that's really hard for people to understand what the difference was then and now, and that I think is a huge piece of it. And once again, that's what saves us from the rental market, right? We are not going to adjust. You know, we're locking in on that mortgage payment. And if it's in our budget now, then it should be in our budget in the future. So we're safe. And that's such a huge sense of security, to know that, you know, my family has a roof over their head and I can afford it. You know what I mean? So, but that
Yeah.
does.
Well,
I have one final question for you, Matt. This
sure.
is something, as of when we bought in 2015, this is what we went through. We went through the pre-approval process and they kept saying, are you sure you don't want to buy a $200,000 house? You're approved for $200,000. Why are you looking at a house in this you know price range? And they wanted us to buy a more expensive house. Is that what we should do?
No, not necessarily. Now, in this market, a $200,000 house is the new $100,000 house, probably. But uh, no, I will tell people a lot of the times that the scariest thing that I can be told is when I ask, "What's your ideal monthly payment?" And they're like, "I don't know. What can I have?" I'm like, "Oh, sweet mother. Okay, this is going to be a good time." Usually, I can predict your credit score based on that response. So don't have that response. Like, you know, we're judging you. But the you need to have an idea of what you can reasonably afford, but also that's realistic within the confines of what is available. If you've got expectation of having a $500,000 house and a $1,500 payment, you're probably not going to pull both of those things off and have no down payment.
Mm-hmm.
I mean, it's just mathematically not going to work. So be realistic, but also set your budget so that you know that you're not going to be eating ramen just because you bought a house.
Right.
To your point about the generational wealth thing, the average net worth of a homeowner versus the average net worth of a renter is literally 40x.
Wow.
So keep that in mind as you're making financial decisions. If it's a matter of, well, maybe to make it work to get a house, I need to cut back on I need to sell the Camaro and go buy myself the Honda. Okay, go for it, because the Honda is going to still get you back and forth to the office or the shop or the whatever you work in. Not as quickly and not as loudly, but it'll get you there.
Yep.
But at the same time, the house is going to make sure that down the road, you've got the money available to retire with dignity and all that. I mean, I'm in the generation that's very, I guess, sadistic not sadistic, that's not the right word, very pessimistic as far as like Social Security, for example. I doubt, I'm not counting on Social Security being something that I've got access to when I get there.
Yeah.
Just the math doesn't work on it anymore. So things to keep in mind, you know, and owning a house even if it didn't pay you back, you got to pay to live somewhere. So
Yeah.
you may as well pay yourself.
Right.
2008 leading into today, there's three major differences. In 2008, you had, first off, the population density of Gen X versus boomers. There's a lot less going on there. That's the reason they called them the baby boom generation. Well, translate that to today, there's more millennials than there were baby boomers. There's also more Gen Z than there were baby boomers. That's your two next eras of home buyers. The average first time buyer is 33 years old, and it's been that way for quite a while. Next thing that's different, we talked about the mortgage stuff. Like the guidelines just weren't there back then. And now I'm going to basically get a reference from your fourth grade teacher before we can close the loan. So like it's a different world now. And then lastly, builders were overbuilding the market because you had all these people buying houses. If you haven't ever watched the movie The Big Short, go watch it on Netflix. It's on there right now. There's a scene later in that movie where they confirm, oh crap, we're in for a big trouble here, where they go and talk with a exotic dancer, and she's got 8 houses. That's the kind of crap that was going on back then. Well, whenever those adjustable rates adjusted on her, she didn't have any need for those 8 houses anymore because suddenly it wasn't working. It wasn't cash flowing for her, which meant that 7 of the 8 at least probably got let go. That happened in mass. Translate that to today. The contractors that remained at the end of all that didn't build close to enough homes to account for the fact that the population density has gone up. Then we add COVID into the mix, and it made things all financially weird by shooting rates super low, and everybody in the country refinanced into a 3%. So if they don't have to sell, they're not. And now rates are high. They couldn't buy their same house again if they did sell it. And you've got a really big like supply and demand issue. The people that are out there chicken littling it, saying the sky is falling, that the market's going to crash. You've got to understand basic economics to understand that it's not going to crash as things currently sit, because there's still a lot of people that have to live somewhere and want to buy somewhere. The rental market's just as tight. They would love to buy a house. There's just not many houses available. Until that flips, it's not going to it's not going to crash. So all that to say, it's still, while you may not see crazy just skyrocketing home values the same way, they're still going to steadily increase the way that they should have.
Absolutely. Yeah, I agree. And I think that sometimes people forget too. So once again, when we look at past home sales in the past couple of years, we're just seeing the generic price it sold for. We're not seeing what it appraised for. So when you think prices have fallen, they haven't. Houses only appraised for X amount, and people were paying a cash difference because the demand was there. It was a supply and demand issue. That's all there was to it. So that house and the loan and an appraiser's eyes was not worth that much, you know? So I think that people see those differences in the numbers and they go, oh my gosh, you know, houses are depreciating. No, they're absolutely not. They are holding their value just fine, and they will continue to increase a little bit at a time, just like they did in the past. Just like you said, I mean, we both said it, you know, when we bought a house in 2015, we never thought those houses were going to be as much as they were. Never. So, you know, we got to just rework our frame of mind. It was a very weird anomaly this past couple of years. And now we're kind of getting back to reality, which is a beautiful thing. It is nice to kind of have a little bit of calm and steady and something that is semi-predictable or just not so volatile. You know what I mean? Like I can get you into a house and know that we're not going to be bringing $50,000 cash over asking price. And that feels good, you know? And I think that to what you said at the beginning, there's never a perfect time to buy. The perfect time to buy is when it's right for you. When are you ready to buy a house? You know, what is most important to you and what do you need out of a house? And is that available? And if it is, then get it and hold on to it, you know? So I don't know how you feel about that, or if you have any other thoughts or points there, but that's kind of how I feel about it.
Yeah, I think that's a perfect wrap right there.
Cool. Awesome. If you could give us one more thing, what's the best website, podcast that you like to refer to for money, loan, mortgage information?
Oh boy. The best website. I'll give you two websites to go to. The first website is howmoneywalks.com.
Okay.
That one purely fascinating. It is like pure fascination for me because it shows you based on tax returns filed how the adjusted gross income has moved across the country from different locations. So it'll explain things like the reason that Nashville's market has gone up in addition to all the surrounding markets. It'll tell you exactly where the majority of the people are coming into Nashville from. And spoiler alert, the people coming into Nashville push up the home prices there, and the people from Nashville then they leave and push up the home prices in the areas surrounding Nashville.
Right.
So that would be the first website. The second website that I go to that's like publicly accessible, I guess it's not like a subscription website, would be you can go to, oh shoot, what's it called? I've got a paid version of it. That's the problem. It's called
We can always link
it totally escapes me. There's a website that shows you where how mortgage bonds are doing on any given day. I'll link to it afterwards.
Yeah.
Basically, on that, the biggest thing that you need to know is not how to read it per se, but it will tell you if that market is going up, that chart's going up, interest rates are getting better. If it's going down, interest rates are getting worse.
Okay.
So that you can use that as a really good resource on a public basis to get a feel for what's actually going on. Because if all you rely on is the stupid ads that say rates just dropped, in proportion to what, in relation to what, you know, by the time the news tells you interest rates are one thing, you're a week removed from that. So don't focus on that.
Yeah. Yeah, I agree. Well, thank you so much. This was a lot of information and good information that can be so useful to everybody that I work with day in and day out. So I really appreciate you clarifying some things, setting us up for success, and really being my go-to VA guy. I sincerely appreciate you and the work that you do, and I'm happy to have you here in the Tennessee market.
Thank you so much.
All right, y'all have a great day.